Happy Tuesday, everyone. Wanted to talk about the differences between term and cash value life insurance. So a term insurance policy is you can get a level premium for 10, 20, 30 years. And it is, in essence, as they say, it is pure insurance. It's kind of like your auto insurance. As long as it's in force, it will cover you. So if you pass away during that time, it's going to cover you for whatever dollar amount that is. And typically, depending on your age that you purchase it, it's relatively cheap. The issues that you run into when that runs out is 30 years down the road, maybe you buy it at 40 years old, 30 years down the road, now you're 70 and you still want life insurance, you're still alive and kicking, and you want your loved ones to still be taken care of, not just by anything you may have accumulated, real estate, any other assets, but you want them to have a death benefit. You try to go get new insurance now, and so what happens is they give you a quote, and then all of a sudden it's like, oh wow, this is way more expensive than it used to be. And now they won't give you that nice long, 10, 20 years of a term. They're going to give you a 1-year renewable term. And what happens with the 1-year renewable term is that they can, whenever it renews, they can increase your rate every single year. Now, depending on the person, that might be a good or a bad thing. The idea when they say buy term and invest the rest, you're supposed to be able to afford it. I can tell you I've run quotes for people and it gets up there. It really does. I mean, it's $6,000 a year and, to start, and then it'll go up incrementally every single year. And shoot, I can't remember the crossover age, but it starts getting up there in the tens of thousands of dollars and it gets pretty high. I've seen some where it shows where if you're still paying on it and you're, say, 85 or 90 years old, it was something crazy like $100,000. But nonetheless, it's not for everyone. I mean, it really isn't. I mean, it is and it isn't, because yes, it's affordable and whatnot. So moving on to cash value life insurance, the differences, right? A difference with this is one, or at least let me go back to term. Term, when it runs out, what you've paid is what you're paying. You get what you get, whether it gets used or not. Meaning that if that coverage, you pay for that coverage, and if it pays out, great. And if it doesn't pay out, then you're paying for new coverage and you get nothing in return. There are versions where you can do a return of what's called return of premium, but again, they're holding onto your money and you get no growth on your money. And essentially you're saving money with them, and it's more expensive. It's a more expensive term product. So, like I say, it's not for everybody. I don't personally, unless somebody just really wants it, I don't recommend it. I look at the idea that you want to keep permanent insurance in place on you. So even if you're young and you have a family, something happens to you, it pays. As long as it's paid for in some way, shape, or form, you can structure these things, even for the banking purposes, you can structure it any way you want, meaning that you can make it a 10-year deal where you pay in for 10 years and then you have coverage for life. You can make it to where you pay in for 5 years. You can make it pay in where you pay in 20 years. It's all up to you. Now, if you're using it for infinite banking, you'd want to pay in until you retire at least. Some people continue even after they retire because the return on paying that premium, especially many years down the road, is so significant that it is retirement income in itself, and all you have to do is pay your premium to get it. I mean, it's nice in the way that it's always going to give you a return It's always going to cash accumulate, and there's always a guaranteed rate of return. Now, I could go way more into that, but the nice thing is it's permanent. So if you go and you have whatever your annual payment, monthly payment, whatever it is, that's going to be the monthly payment for the rest of your life. And it can be structured to where it may have a smaller death benefit than term to begin with. But as the years go on, if you structure it properly, it's not only going to grow your cash value, but it's going to grow your death benefit as well very nicely, to the extent that even if you have a lot of money in there, there's always far more death benefit because it's continued to increase the death benefit with the years. So there are big differences, and I'm partial, I say I've been doing banking for 12 years. I'm very partial to the cash value permanent insurance. And there's other versions of permanent insurance. They can be used for certain things, not so much for banking in my opinion, but the general idea is using them for the banking and for my purposes, in my opinion, but not everybody does this with their policies. Should they? Yeah, I think so. I wouldn't want to park my money there to just grow. I would like to also enjoy the money while I'm living, and living wealth. There's something to be said for that. For the people who are utilizing it so they could, in the infinite banking concept, they get out of debt. Well, you're not necessarily changing anything. You're not necessarily making more money, but as long as you're able to put this money away, you're able to make this money work harder for you. So if you can get out of debt and build a nest egg at the same time, you're not having to allocate this many dollars to get out of debt and then this many dollars towards retirement or whatever that purpose is for savings, for example. You're able to make it do both. And it's very unique in that way. And it makes it very, it makes it amazing to me because you're not just focusing on one or the other. You're not just focusing on putting money away from retirement and you're like, oh, I'm just going to pay, the minimums on my credit cards and make my car payments and whatever. You're able to actually finance all of that. Your payments can go back into your policy. And when you're putting them back into the policy, once everything's paid off, if it's structured in such a way, you might have room to be able to put more money into it to make it grow even more, which would accelerate the growth down the line as you go, if you're able to put this extra money. Now, if you get to where you can't put any money anymore and you need a place to park your money, then you can always do another policy, which is not a bad thing. What do banks do? Whenever they hit capacity at one bank, they open another one. They open another branch. You see them on every corner. Look at Chase. Look at all the big banks. They got one at every single corner. So for your purposes, you could do it for yourself. A lot less complicated, but you still have a lot of the same functionality from doing this as a bank would. And it can get way more in-depth and it can get way more useful. So anyway, I'm kind of getting far into it, but the differences between term is just that. It's for a set period of time. You get, for the most part, you get nothing in return if you don't die while it's in force. The whole life, you obviously you get an increase on your money. The insurance company is giving you money because they're holding on to your money. So they're able to pay you interest, and it's compound interest. And compound interest, is the best way to grow your money. It's working for you while it's sitting there. If you put it in a bank account or a savings or a checking account, the rate of return is, I mentioned this before in other videos, but it's less than 1%. And then there's probably a monthly fee depending on the situation, unless you're over a certain dollar amount. Depends on the bank account you open. Some might have a minimum of $100,000. Some might have a minimum of $5. Others might have a minimum of $1,500. It just depends on the bank account. And I can tell you that my checking account pays me a little, some interest or some return, but it's negligible. I mean, it's not much. You whenever you see it, it's pretty funny because you can have all the money in the world in there, but it still doesn't pay you hardly anything. So anyway, hope this helps. Hit the like, subscribe, and hit the notification bell for me down below. I'll be doing some more videos, of course. If there's anything you want to hear about, anything that you have questions about, I mean, anything even I've said, you want me to expand on that, please put it in the comments down below. I'll be glad to do a video in response. Have a good one.